Well, they have great earnings, but to Jenny's point, there has been a multiple contraction in software, and I don't know that it's over yet. So you've had companies with outstanding results. CrowdStrike's a great example, but Wall Street has already told you in advance, we don't care how great those results are. This stock is not going to sell where it was selling if the cost of money is rising, if the risk-free rate is going to serve as any kind of competition for these assets. Now, I happen to think there's a little bit of a clown show going on with people taking Powell's words at face value and actually believing that he could do something like double the pace of the taper. If that's what you honestly think is the new base case, I don't know what ball game you've been watching. I doubt the taper will be sped up, and if it is, I doubt it will happen in meaningful amounts. He can't do it. Don't forget where terminal levels for rates were in the last rate hike cycle in 18. He tried to get to 2%. He ended up inverting the yield curve, okay? So if your base case is that all of a sudden Powell's going to turn into this hawkish, inflation-fighting Paul Volcker figure, you really should not be managing your own money. You should give it to somebody else, because that's not where this is going. And if you're also worried about Omicron becoming this horrific thing, then the Fed is out of the picture. They're doing nothing. There is no taper. So I don't know if I agree with Jenny that you can't own any companies that have long duration cash flow expectations or any higher multiple names. I think, like in most cases, you want to strive for a balanced portfolio. You want companies that are cheap, of course, and I think you could find them in financial services and energy, but I also think you want growth. Because if we're going back to trend growth, which I think is likely, the high growth names are always going to have a bid, right? So yeah, you want to pick your spots, of course, but I think you want to have both in your portfolio and not think that you know what the regime ahead of us is definitely going to be. That's a very tough game to play, as hard as it is to time the overall market.
Go ahead, Jenny.
Okay, thanks. So I want to be really clear. I agree with you, Josh. You don't need to not own any high multiple names. But if you do own a high multiple name, you have got to have the earnings growth to back it up. So I don't think you should be buying something right now that trades at, say, 50 times earnings and only has 3, 4, 5% earnings growth. It's not the way it was last year. You cannot use the broad brush. You can't say I'm going to buy the what Edgar Denny calls the Mag 8.
How about 50 times sales?
You can't buy. Right. Okay, you can't. And so you need to be really, really careful and picky this year. But even if you look at the payment processors, there's like 30 companies in that industry. They're not all equal. You need to suss through it and figure out which ones of those are down 40% without justification. Some of them are justified in being down so much. So yeah, this is where I look at the list of the Peloton, Zillows, Lemonades, Roku's, Pinterest's, DraftKings. They're all down, like 75%. I don't think that many of them are going to recover because they do not have the earnings growth to have supported what the previous multiples, if they even had one, were.